Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the deep dive. Today we're tackling one of those paradoxes you see in finance that just seems to break all the rules.
It really does.
We hear constantly about mergers, about getting bigger to create scale and synergy. And yet, time and again, you'll see a company, a huge one, intentionally break itself up.
And the market loves it.
The market cheers. The stock prices for both new companies often jump. So the question for our deep dive today is pretty simple. Why? Why does breaking up so often unlock so much value?
Well, that's what we're here to pull apart. Corporate spinoffs are they're a really powerful tool in the corporate strategy playbook. Our mission is to get into the mechanics, the strategic logic behind them, and maybe most importantly, the massive challenges the finance teams face trying to pull one of these off.
Okay, so let's start with the absolute basics, because the terms here can get a little messy. When we say a company's breaking off a piece of itself, we're usually talking about a spinoff. What exactly is that?
So at its core, a spinoff is a non-cash deal. The parent company, let's say a big conglomerate, takes one of its divisions, a subsidiary, and it distributes shares of that subsidiary directly to its own existing shareholders.
So the people who own the parent now own the parent and this new separate company.
Exactly, proportional to what they already own, and boom, the new company is born. It's fully independent, has its own board, its own CEO, and its own unique mission.
I see spinoffs get confused with things like carve-outs or divestitures all the time. Are they basically the same thing?
They're in the same family of tools, for sure. The goal is always more focus, but the mechanics are very different. A spinoff, and this is critical, is generally tax-free for shareholders.
Which is a huge win.
A massive win. A carve-out, on the other hand, is more like a mini IPO. The parent sells, say, 20% of the subsidiary to the public for cash, but keeps control of the other 80%. A divestiture is just a straight sale, selling the whole unit to another company for cash.
I see. So the spinoff is really the premier tool for this idea of unlocking value without a big tax bill or just cashing out.
That's right.
Okay, that makes sense. Let's move on to the big question, the value creation part. What are the, say, 4 main reasons that making a company smaller can suddenly make its total value bigger?
Right. So we see 4 themes come up again and again. The first, and maybe the most important, is strategic focus.
What do you mean by that?
Well, imagine a company that runs, I don't know, a mature, slow-growing utility business and also a super high-growth, cash-burning software business.
Okay, 2 totally different worlds.
Totally different. They compete for the CEO's attention, for capital, for everything. The KPIs for one make no sense for the other. By separating them, you let each management team focus only on what matters for their specific business. The utility CEO worries about cash flow. The software CEO worries about user growth.
You remove that internal friction.
You remove the distraction. And that leads right into the second pillar, better incentives and governance.
Right, because you can't pay the CEO of a utility the same way you pay the CEO of a tech startup.
You absolutely can't. Once they're independent, the board can tailor the compensation perfectly. The software company can offer huge stock option packages to attract top engineers. You couldn't do that if you were tied to a parent company focused on paying a steady dividend.
So it prevents the high growth part from being, I guess, held back by the slow growth part.
Exactly. And that brings us to the third one, which is where you see that instant stock jump. It's the valuation re-rating, or what people call the pure play effect.
Okay, so this is the market's reaction. Explain that for us.
The market hates complexity. When an analyst tries to value a conglomerate that owns, say, an aviation unit, a healthcare unit, and a finance unit, they get stuck.
How do you even compare that to anything?
You can't, really.
Yeah.
So they apply a blended discounted valuation. It's called the conglomerate discount. The market basically just says, this is too complicated, we're marking it down.
The market is penalizing the messiness.
Perfectly put. When you break them apart, each new company trades as a pure play. The healthcare company is now valued against other healthcare companies. The aviation company against other aviation peers. Suddenly, the sum of those individual, properly valued parts is way higher than the old, messy whole.
That's where that day one value unlock comes from, which connects to the 4th pillar, right? Capital allocation freedom.
It's the engine that drives the strategy. Think about our 2 businesses again. One needs to pour billions into building 5G fiber networks over the next decade.
A huge long-term investment.
Right. And the other is maybe a consumer goods business that just spits out predictable cash and doesn't need much reinvestment. Its job is to pay dividends and buy back stock.
So under one roof, they're fighting over the same pool of money.
Constantly. And one of them is always losing. Either the growth business is starved for cash, or the mature business is forced to cut its dividend. Separation lets each company build a capital plan that actually fits its own strategy.
So when you look at all four, it's clear. Spinoffs aren't really about shrinking. It's more like corporate sharpening.
That is a great way to think about it.
Let's make this real with some case studies.
Yeah.
I mean, we have to start with the classic. PayPal and eBay back in 2015.
Textbook example. Before the split, PayPal was this amazing payments engine, but it was tethered to the eBay marketplace. Its main job was to process eBay's sales.
But its real potential was way bigger than that. It needed to be the payment button on every website.
On every website. But how can you aggressively partner with Amazon or other retailers when your parent company, eBay, sees them as the enemy? The strategic conflict was obvious.
Right.
The moment it was independent, PayPal was free, it went on a partnership blitz, it could raise its own capital for acquisitions, and the result? Its market cap more than doubled in just 3 years. That's a direct result of strategic focus and capital freedom.
Okay, now for a more recent and much more complicated one, AT&T spinning off Warner Media in 2022.
Yeah.
That felt different. Less about growth, more about survival.
It was absolutely driven by that capital allocation problem we talked about. AT&T's core business, telecom, is a monster that eats capital. 5G spectrum, fiber to the home. We're talking hundreds of billions in disciplined spending.
And media, especially in the streaming wars, is also a capital-eating monster, but a much less predictable one.
Exactly. You have to spend billions on content with no guarantee of a return. AT&T just couldn't afford to feed both of these empires at the same time. Their debt was enormous.
They're drowning in it.
So spinning off Warner Media, which then merged with Discovery, let AT&T get back to basics. It could focus on being a telecom company and pay down that debt. And the new media company got a leadership team that only thinks about content and streaming. It was about strategic clarity.
And then there's the biggest of them all, the ongoing breakup of General Electric, GE. This feels like the ultimate pure play story.
Oh, absolutely. The GE breakup is probably the most significant restructuring we've seen in a decade. You're taking this sprawling giant and separating it into 3 focused companies: aviation, healthcare, and energy.
Businesses with nothing in common, operationally.
Nothing.
Yeah.
Different margins, different customers, different market cycles. Before, GE was the poster child for the conglomerate discount.
Yeah.
Now, GE Healthcare trades against other medtech firms. GE Aerospace trades against other aerospace suppliers. The collective value is projected to be so much higher than the old GE. It's the pure play theory in action.
The strategy is clearly powerful, but the execution,
Yeah.
that's where things can go wrong. Let's shift to the internal challenge. This is where the finance teams, FP&A, Treasury, have to make it all happen.
And this is where the real risk is. You can have a great strategy on a PowerPoint slide, but if the finance team botches the separation model, the whole thing falls apart. There are 5 really critical areas they have to nail. The first is just testing standalone viability.
Meaning, can this new company actually survive on its own?
Precisely. The finance team has to build from scratch a full set of standalone financial statements, a P&L, a cash flow statement. And what they often find is that the business unit wasn't as profitable as it seemed when it was, sheltered by the parent scale.
That leads right to the second, and probably the scariest part: stranded costs and dis-synergies.
This is the value killer. This is where spin-offs fail.
Explain what that means. Dis-synergies.
It's the opposite of synergy. Think about all the shared services: the IT department, the HR systems, the legal team, accounting. They were all shared across the whole company, creating economies of scale.
But now you have to duplicate all of that.
You have to duplicate it, or the parent has to provide it back to the spin-off for a fee under something called a transition service agreement. But those are temporary and expensive. The spinoff eventually has to build its own IT infrastructure, its own HR team. The cost of that duplication, the dis-synergy, is almost always underestimated.
So the hidden cost can just eat away at the expected value unlocked.
They can completely wipe it out if you're not careful. Then there's the third piece, capital structure design. You have a pile of corporate debt. Who gets it?
Right. Who's responsible for what?
The Treasury team has to carefully divide the debt, making sure both new companies have a healthy credit rating and a leverage profile that fits their new strategy. You don't want to saddle the high-growth spinoff with so much debt it can't invest.
And to sell all of this to the board, they have to prove the math works.
That's number 4, the sum of the parts valuation, or SOTP. This is the model that shows, here's what the company is worth today, and here's what the two separate pieces will be worth based on their pure play peers. If that second number isn't significantly higher, you don't do the deal.
It's the business case, boiled down to a number, and finally, you have to sell the story.
Yes, investor communication. The finance and IR teams have to craft an absolutely crystal clear narrative. Why now? What's the strategy? And critically, what should investors expect in terms of those dyssynergy costs? Any confusion there, and the market will punish you.
We've heard the success stories, but it's not always a home run. When does this all just blow up? When does breaking up fail?
It usually comes down to a couple of major mistakes. First, the new company just isn't strong enough. It lacks the scale to compete on its own, or it was secretly leaning on the parent way more than anyone realized.
So management misjudged that standalone viability from the start.
They misjudged it, and they underestimated the dyssynergies. The synergies of being combined were actually higher than they thought. The other reason they fail is, frankly, cynicism.
What do you mean?
Sometimes the market sees a spinoff as just a gimmick to dump a company's garbage assets. You're not unlocking value, you're just isolating a problem. If the fundamentals of the new business are weak, a spinoff won't save it. It'll just expose the weakness faster.
So for our listener, the next time they see a major spinoff announced, what should they be looking for to judge if it's a smart move?
Look past the headline. Dig into the details of those dyssynergies. Did the company give a clear estimate of the transition costs? Look at the new capital structure. Does it make sense for the new company's strategy? And is the story they're telling investors clear, confident, and honest about the challenges ahead?
The most successful ones seem to be the ones where management is brutally honest about the costs and complexity.
Absolutely, because it all comes back to that core idea. It's about creating sharper focus, clearer incentives, and more disciplined capital allocation.
It really makes you realize that sometimes the most powerful strategic move isn't another acquisition. It's not about getting bigger. It's about radical simplification.
The quest for pure play is a powerful force on the market.
It really is. And it makes you wonder, what other big, messy conglomerates are sitting in boardrooms right now, looking at their own structure and asking if it's time to unlock value by simply letting go?
A very interesting question to think about.
Indeed. Thanks for this deep dive today. It was fascinating.
My pleasure.
We'll catch you next time.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.